Dear colleagues, first of all, I want to apologize that I cannot be with you at this exciting conference. Stefan Hobler invited me a year ago, and I learned from him that many prominent speakers in the past have made their presentations, and they talked to an audience which participated vividly in all discussions. So I really regret that I missed this exciting atmosphere. I can reassure you that it's not my habit, has never been my habit to cancel commitments. But in the meantime, means since Stefan Hobler invited me, I became member of the Eminent Persons Group. This is a group, a small group of economists from all parts of the world, which are mandated to discuss the working of the international financial and development institutions, first of all the IMF and the World Bank, but also any other international institutions in this field. We are supposed to prepare a report to those who have created this group. This is the G20 group of finance ministers and central bank governors. We have to present our final report with recommendations to the G20 finance ministers and central bank governors. Unfortunately, the timing of our meetings and related work is such that I could not take part in this conference. Again, apologies for that. I was invited to speak about monetary policy. In 2018, I think we will see if central banks in the world will end their extremely expansionary monetary policy. The Fed has started to stop quantitative easing and to raise interest rates. The European Central Bank has announced that it will still continue buying assets and keeping interest rates at the extreme low level which exists at present. So monetary policy in the euro area is now more expansionary than at the time of the Great Recession. And it's getting even more expansionary due to the fact that the European economy is growing. In spite of commenting now on the course of monetary policy, I want to touch upon more fundamental issues in my short presentation. For decades, central bank independence was not an issue at all. There was one exception, this was Germany. In Germany in 1948, the Allies, or rather the American representatives, have imposed, so to say, independence of the central bank, at that time Bank Deutsche Länder, to Germany, which existed as a state only 1 year later. When the law on the Deutsche Bundesbank was discussed, Chancellor Adenauer was strongly against giving independence to the Deutsche Bundesbank, but he lost this battle because the Bundesbank was supported already strongly by the public. When the Maastricht Treaty was discussed, negotiated in the beginning of the 90s of last century, there was no other European Central Bank given independence. But nevertheless, the statute on the European Central Bank is based on two pillars. One is central bank independence, and the other is a clear mandate for maintaining price stability. This can only be explained against the background of two factors. First, it was the example of the Bundesbank, the stability of the DM, which had to be seen as the most stable currency in the world together with the Swiss franc. And so the Bundesbank and the DM were a kind of model for the future European monetary system. And the other factor was research which over the 80s had demonstrated that there is a strong correlation between the degree of central bank independence and the degree of price stability. Following the example of the ECB, central bank independence was given to most players in the world. And in the so-called Great Moderation, which describes a situation of low inflation, high growth, low unemployment, it seemed that this statute for central banks and the corresponding monetary policy had strongly contributed to this Goldilocks situation. This period significantly enhanced the reputation of central banks and their leaders. The most renowned of them, the chairman of the Federal Reserve, Alan Greenspan, was even called Maestro. The prestige of central banks was further increased in the context of the Great Recession. Timely and forceful actions of monetary policy have contributed to prevent the global economy falling from a Great Recession to a deep depression like in the 1930s of last century. As a consequence, central banks were even seen as extremely powerful in managing the economy. Accordingly, they were often even called masters of the universe. However, this is a tall order that central banks alone cannot deliver. Central banks have applied special instruments to stimulate the economy. More and more, the boundaries of monetary policy have become visible. Disappointment with politics in general, combined with the lack of trust in politicians, has further contributed to this elevated status of central banks. A special case in this context is the European Central Bank. During the course of the continuous crisis of monetary union, the ECB has been seen as the only institution able to act on time, disposing of the necessary instruments, which in the end implies printing money. Central banks on a global scale have become overburdened for two reasons. The first is expectations of what they can achieve. This, what I would call expectational overburdening, applies also to prominent central bank leaders. The other dimension is implied in overloading the central bank with more and more responsibilities and competencies. One might call this institutional overburdening. The biggest challenge for central banks now lies in the responsibility to preserve financial stability. A broad consensus has emerged that guaranteeing price stability is important, but is not enough. High risks to financial stability can develop even when low inflation is preserved. A stable environment can foster excessive risk-taking, leading to fragility in financial markets and ending in collapse of the system. This is called the Minsky moment. The question is there a trade-off between price stability and financial stability? This is the key question arising from the consensus mentioned above. While a conflict in the short run cannot be excluded, there is no reason to sacrifice price stability in the medium to longer term with the aim of fostering financial stability. However, a central bank will lose its reputation if it is perceived as having underestimated or even neglected the challenge coming from financial instability. This is basically true almost independently if the central bank is responsible directly given a mandate for preserving financial stability, or it is not. To date, overburdening and the implied risk to reputation apply to all major central banks. Yet, the European Central Bank is a special case. It is unique in many respects. The major one is it's a central bank for 19 sovereign countries. This leads to extraordinary overburdening. In 2014, the European Central Bank was mandated with the task of banking supervision. Banking supervision for major banks in the euro area. The establishment of the single supervisory mechanism, SSM as it is called in abbreviation, will unavoidably, to my mind, bring the European Central Bank into conflicts with its policy to maintain price stability, which is and remains its fundamental task. An unprecedented degree of overburdening of the ECB emerged in the context of the crisis of the Monetary Union in 2010. By intervening in the government bond markets to prevent long-term interest rates from rising in some countries, the central bank fell into conflict with the prohibition of monetary financing, which is an important element of the Maastricht Treaty. The European Central Bank's intervention was widely perceived as a kind of guarantee for the membership of every country within Monetary Union. This notion was driven to the extreme by the announcement, whatever it takes, by its president Mario Draghi. In this context, the ECB plays a political role that is not in compliance with its status of independence. The status which is and can only be related to its monetary policy to maintain price stability. Pertinent failures of national economic and fiscal policies have caused deep crisis for the European Monetary Union. With its actions, the ECB is bailing out countries de facto from situations that could lead to strong increases in long-term interest rates and may raise doubts about the sustainability of its membership in Monetary Union. By those interventions, the European Central Bank undermines and in the end destroys the role of financial markets as guardians of fiscal and other policies of fiscal policy and other policies of member states. This is an even more dangerous situation for the stability of the Monetary Union, with the disappearance of the bond vigilantes, which means the control by international financial markets, has been dismantled by the pure political discretion of the European Commission. As a consequence, there exists hardly any control now of national fiscal policies on the European level. The perception that the European Central Bank is the only game in town demonstrates an extreme disequilibrium in the distribution of power in the European Monetary Union. However, a democratically legitimate solution cannot be achieved by centralizing fiscal power at the European level, but by respecting the limits that are set by the sovereignty of member states. This could be altered only by a change of the treaty, which is not a realistic option for the foreseeable future. On a global level, the independence of central banks is undermined by two developments. The first one is implementing instruments with direct distributional consequences. Decisions of this kind must remain in the domain of politics, which is ultimately controlled by voters and cannot be the competence of an independent central bank. The other conflict is with the state of The other conflict with the state of independence is implied in acts of coordination with fiscal policies. The more monetary measures are de facto acts of fiscal policy, see the actions of the ECB, the more they are exposed to criticism that they do not comply with the central bank's status of independence. This is also seen in the context of overburdening, as explained before. To the extent that central banks yield to political pressure, independence may still exist de facto, but is abundant. Independence may still exist de jure, but is abandoned de facto. So far my short comments on the situation of independence of central banks in the world. Thank you for your attention, and again I apologize for not being able to be with you, and I wish you a successful conference. Bye-bye.